dollars on this research. So clearly they're looking at taxing our homes. It hasn't come in place, but we need to watch that and how that's going to impact our real estate investments. So the key findings in the Canadian Financial Capability Surveys is actually quite worrisome. Canadians are in debt, and this is in 2009, before the pandemic. 177% of disposable income in the average Canadian household was going to debt. This is crazy. So this is before the pandemic hit. So we can see that you know, the reasoning behind money being printed right now is that Canadians are having trouble keeping up with their debt. And these stats are even more worrisome for people who are 65 and over, who most of them claim they're just having difficulty paying their bills right now. So we've got an aging population who is in a downward slide right now, which is very worrying right now. So a lot of that debt, interestingly, is tied up in mortgages. So, and also about 13% of Canadians have a home equity line of credit on their homes as well. And then we've also got other types of credit, and these are the ones I'm more worried about, is the ones on credit cards, vehicle loans, personal lines of credit, student loans, basically consumer debt, which has actually been really easy to get over the last few years. So after the subprime mortgage crisis happened, it's gotten really much harder actually to get a mortgage. However, the other types of credit have been really easy to get. And so a lot of people have been jumping on board. And yes, they are starting to pay off their credit card debts, which is a really good sign. I'm just wondering if it's a little too late with the economy going down as it is. So affordability wise, what's going to happen when our tenants who have opted to not pay us, will they be able to pay us back? Well, the question is, if they weren't able to pay us before, are they going to be able to pay us more later? So, so we've got the residential eviction ban is going to be lifted September 1st in BC, and I do believe other jurisdictions are going to be following towards this. So just to give an idea of what the average renter is looking at who has taken this option. So a renter owing 4 months rent at $2,000, so it's $8,000 total in unpaid rent, now have to pay back their landlord by July 2021. And so they need to be adding $800 a month to each of their rental payments to pay that back. I don't know about you, but I'm not sure our tenants are going to be able to afford that, especially if they may still be jobless right now. So that may impact a lot of things in, especially in the rental housing market. But this is also going to be showing as evictions, because landlords will be able to now start to evict tenants who are not paying. And when it comes to financing, so introduction of the stress test in 2018 has removed the ability of home buyers and investors to enter the market. A figure I saw was about 20% of people no longer qualify for a mortgage. I'm one of those people. I can no longer qualify based on the new rules. However, this is something that is probably really good for the Canadian economy in that it's helping to reduce the amount of debt that Canadians hold. But I think the problem is people are now shifting into consumer debt, which is a lot higher in interest rates rather than mortgages. So I'm not so sure it's really helping. Okay. So when we talk about interest rates, now I really wanted to dig deep into the interest rate issue because that's something that we're going to be really impacted as investors going forward. So I wanted to know what the heck determines the Canadian interest rates and interest rates in general, because I know I don't pay the Bank of Canada rate. The Bank of Canada rate is what, 0.25% right now, Keith? It's low, but I don't know. I don't pay that rate, and I don't know anyone. There we go. Yeah, I don't know anyone paying 0.25% on any loan that they've got right now. So where's the gap here? How are interest rates determined? So I actually did some digging into this, and so interest rates are determined by a number of factors, actually. And yes, the Bank of Canada is one of those factors. But there's also supply and demand for loans, availability of lending capital. Our interest rates are actually highly based on what the US does as well. If you notice, once the lockdown started and the Bank of Canada started dropping its rates, the US would drop their rate, and the very next day Canada would. So whatever the US does, we tend to do like right after. So we need to be watching what the US is doing with their interest rates, because chances are we're going to be doing that too. There's also inflation rates that impact interest rates, and other economic factors that control interest rates. So the main interest rate factors that will be impacting interest rates into the future. So they'll stay low for now, for sure. But the things that affect interest rates is the risk to the borrower. So with consumer debt, for example, on a credit card, most credit cards have very high interest rates, 28% or 30% on the credit cards. And why is that? Well, it's because it's a very high risk to the lender to lend that money. There's no collateral there. There's a lot of default in credit card payments. So the interest rates are high because they have to be able to make money off that money that they're lending. And also, the longer that the money is being lent, the more risk that the lender has, because inflation will actually reduce the amount of money that comes back to them. So, so if you're looking at a 10 or 20-year mortgage, you're going to be paying higher interest rates because you're borrowing for a longer period of time. Now, inflation is another big one, because that's something that's going to be that's on my radar, especially because that will also affect, as I said, how much the lender will receive. Now, in the 1970s and 80s, when we saw some really crazy interest rates up to above 8%, there was a point in time I heard that people were walking away from their houses because their interest rates were so high, upwards of 20%. They found that uncertainty was a really big factor into interest rates, and as we know right now, everything's uncertain right now. No one's got that crystal ball. No one really knows what's going to happen. So that can play a really big factor in what happens in interest rates as well.
Monica, that what you just said is reflective of what happened early in the pandemic,
Right.
when there was so much uncertainty with as far as employment and stuff. The banks had no clue as to what people's employment situations were going to be and their ability to repay. So even though the bond yield really dropped off fast and in a hurry, took them a long time to start dropping interest rates to a point where they felt more comfortable with people's ability to pay. So that was a direct reflection of exactly what you just said.
Right. Yeah. So, so if you're only looking at the Bank of Canada rate, like, you're missing the boat here. That's only a small fraction of what determines actual interest rates that we pay. Okay. So that's right. Yeah. The lenders are really reluctant. I mean, I contacted my lender and they did not want to give me a deferral, and so they were. Yeah, it was just uncertainty at that time, and so I saw it directly with the lenders that I was trying to deal with as well. Now, inflation. This is a crazy number that just came out last week.